Silver is in one of its most volatile and important moments in years, and the action between January 6 and 10, 2026 is setting the tone for what comes next. Over this week, COMEX silver opened around $76.50 per ounce, pushed up toward roughly $78.50, and then pulled back to close near $77.35, leaving a gain of about 2.6%, but with violent intraday swings of more than 4%. Asian trading led early in the week, with strong buying in Shanghai overnight on January 6 and 7 pulling New York futures higher into the US Open before a sharp midweek reversal produced what many called a New Year's hangover in silver. That reversal was driven more by technical profit-taking and positioning than by any sudden change in underlying physical demand or mine supply. The key thing to understand is that the paper price on COMEX and the real price for physical metal are no longer the same story. As of Friday, COMEX spot sits around $77.35 per ounce, but Shanghai's SGE market has been trading roughly $82 to $87, a premium of about $5 to $10 over New York, even after narrowing from the even more extreme levels seen late last year. In China's domestic futures market on SHFE, prices are similarly elevated, often $6 to $11 above COMEX, showing that domestic industrial and investment buyers in Asia are still willing to pay up for real metal. In Western wholesale markets, the gap is smaller but still visible. London OTC spot has been trading only about 15 to 65 cents over COMEX, which means arbitrage between London and New York is functioning normally and liquidity there is adequate. Dubai and Tokyo, on the other hand, are pricing silver around $80 to $84, $3 to $7 above COMEX, reflecting the pull from Asian physical demand and the cost of getting deliverable bars into those hubs. If you step down from wholesale to the retail level, the disconnect is even clearer. In the United States, American Silver Eagles have been selling around $83 to $88 per ounce, or roughly $6 to $11 over spot, a massive premium that reflects mint constraints and strong investor demand for sovereign coins. Generic 1 ounce and 10 ounce bars and rounds are a bit cheaper but still trade near $80 to $83, $3 to $6 over COMEX, which is far from normal in a balanced market. Despite this, the futures curve is not screaming panic. Front-month futures are only slightly below or in line with spot, and outer months like March and April trade with mild contango, March near 77.74 and April near 77.99, suggesting tightness but not a full-blown delivery crisis. In other words, structural supply and demand are tight, while short-term trading flows and profit-taking are creating the visible volatility. Under the surface, inventories and positioning tell a story of a market that has already been under pressure for months. COMEX registered inventories, the metal that is actually deliverable against futures, sit near 128 million ounces, the lowest level since early 2025 and well down from the highs of the last few years. Eligible silver, which is stored in the system but not committed for delivery, is about 321 million ounces, down roughly 6% from the record 342 million seen in October 2025. When you compare this to open interest, the stress becomes clearer. Total open interest is about 155,710 contracts, each representing 5,000 ounces, which means there are roughly 778 million ounces of paper claims versus that 128 million ounces of registered metal. On a simple ratio basis, that is about 6 ounces of paper for every ounce of deliverable silver, down from the most extreme points but still an elevated leverage level. Crucially, that open interest has actually fallen by about 6% since late September, even as the silver price has jumped nearly 58% over the same period. Normally, a speculative blow-off rally is accompanied by rising open interest as funds pile into long positions, but here the opposite has happened. That tells you this rally is being driven by a mix of physical demand and short covering by commercials rather than a wave of leveraged speculative buying. The commitments of traders' data reinforces this point. As of the latest report, hedge funds and other managed money accounts are net long just over 21,600 contracts, down almost 42% from about 37,000 long in late September. Swap dealers have cut their net shorts by about 32% to roughly 30,000 contracts, and producers have trimmed their net short exposure as well. As one Sprott money analyst put it, this environment shows that the narrative of hedge funds driving the rally through aggressive futures buying simply does not match the data. Instead, financial demand is showing up more clearly in ETFs. The iShares Silver Trust, ticker SLV, has reversed 4 straight years of outflows and is now pulling money in at a rapid pace. In the most recent week, SLV saw around $135 million of net inflows, part of roughly $2.3 billion of new money this year, and it has hit a new 52-week high with a 178% gain off its low. Other physically oriented products are seeing similar patterns, with one example, the Aberdeen Physical Silver Fund, growing assets to about $4.1 billion after roughly $900 million in net inflows. This is capital that must be backed by allocated bullion, pushing quietly but steadily on the physical side of the market. On the macro front, the next few weeks will be dominated by the tug-of-war between inflation, interest rate expectations, and the US dollar. The December Consumer Price Index report is scheduled for Tuesday, January 13 at 8:30 a.m. Eastern, and it will heavily influence how traders price the path of real rates. A hotter than expected reading would tend to support higher real yields and a stronger dollar, which usually weighs on precious metals in the short term, while a softer report could reignite hopes for faster rate cuts and fuel another leg up in silver. Later in the month, the Federal Reserve meets on January 27 and 28. As of now, market-based probabilities imply only about an 11% chance of a cut at that meeting, even though some political voices have called for as much as 150 basis points of easing over the course of 2026. Several Fed officials have signaled a much slower and more cautious path, pointing to the risk of cutting too soon, and this divergence between political pressure and Fed guidance is helping keep macro volatility elevated. Zooming back into the real economy, the industrial demand story for silver remains one of structural growth rather than short-term speculation. The energy transition, especially solar and electric vehicles, is at the center of this. Longer-term studies suggest that by around 2030, solar and EV applications alone could be consuming roughly 50% of annual global silver mine output, up from significantly lower levels just a few years ago. This week did not bring major new numbers on global solar installations, but commentary has not changed. Order books and backlogs remain strong, and silver loadings per panel, while subject to gradual thrifting, are still high enough that total demand rises as capacity expands. In electric vehicles and advanced energy storage, work on silver-intensive solid-state batteries is progressing. Some designs could require around 1 kilogram of silver for a 100 kilowatt-hour pack, and even if only a fraction of global EV production adopts such chemistries later in the decade, the implied incremental silver demand could be on the order of 16,000 metric tons per year. That is a huge number relative to today's total mine production, which sits around 820 to 850 million ounces annually, or roughly 25 to 26,000 metric tons. Importantly, there have been no credible new breakthroughs in substituting cheaper metals like copper or aluminum at similar performance levels in these high-end applications, leaving silver in a uniquely advantaged position. Industrial behavior this week confirms that users still see dips as buying opportunities, not as a reason to pull back. In Shanghai, reports describe downstream manufacturers actively inquiring and negotiating prices and engaging in rigid stocking demand after the midweek price decline. That language matters. It suggests that factories are maintaining or building inventories rather than drawing them down, and that their production plans, and thus their underlying silver requirements, are intact. At the geopolitical and policy level, China's new export regime is the structural pivot point. From January 1, Beijing has tightened controls on refined silver exports, effectively restricting the flow of metal to Western markets. This has coincided with persistently elevated Shanghai premiums, and there has been no sign this week of any backtracking or softening of enforcement. The result is a two-tier market, one price inside China and nearby hubs, where demand is robust and supply constrained, and a lower benchmark price in New York that reflects paper trading more than direct access to deliverable metal. Taking all of this together, the best description of the current market state is tightening. It is not yet fully breaking in the sense of failed deliveries or extraordinary backwardation across the curve, but stress is clearly building. Shanghai's $5 to $10 premium over COMEX, even after some easing, is not something you see in a balanced system. COMEX registered inventories at multi-year lows and a paper-to-metal ratio around 6 to 1 show that much of the market is still built on leveraged claims rather than fully backed ounces. And the fact that hedge funds have cut longs into a 50+% price rally, while ETFs and physical buyers quietly absorb metal, tells you the smart money is shifting its attention from short-term charts to long-term scarcity. There are still real data gaps and uncertainties. LBMA vault numbers are not fully current, so it is hard to say precisely how much metal London has lost, or gained, to Asia in recent weeks. Chinese exchange inventories are reported with limited granularity, which means analysts must infer tightness through premiums and anecdotal reports rather than precise stock levels. Over-the-counter flows between bullion banks and large clients are almost entirely opaque, leaving a significant portion of global trade in the dark. Looking ahead, 3 upcoming data points could sharply refine the picture. First, the next commitments of traders release will show how futures players reacted to this week's volatility, whether funds finally started chasing the move, or whether commercials continued to quietly cover shorts. Second, the CPI report on January 13th will help determine whether real rates act as a headwind or tailwind to precious metals in the near term. And third, the next update of LBMA Vault Holdings, whenever it is published, will reveal whether London's bullion stockpiles are being drawn down to feed Asian demand, or whether the West is successfully holding on to its remaining inventory. For investors and industrial users, the implications are clear. In the short term, expect more volatility driven by macro headlines, technical levels around $75 and $80, and rapid shifts in positioning. But beneath those swings, the structural trends, tight inventories, persistent Asian premiums, growing solar and EV demand, and new constraints on Chinese exports, are all pointing in the same direction. A market where real metal is steadily becoming more valuable relative to paper promises. If you found this breakdown helpful and want to stay ahead of what's happening in silver, make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss the next update.